How U.S. policy blunders are driving the world away from the dollar and what it means for you. Are we witnessing the decline of the U.S. dollar's dominance in the global economy? Learn how recent economic decisions and geopolitical strategies might be undermining the dollar, causing nations to seek alternatives, and what this shift could mean for your financial future. Stay tuned to understand the implications of these missteps and how you can protect your assets in these uncertain times. The U.S. is expected to experience a severe recession with no way out of it, and the value of the dollar is cut in half in years. This is a dynamic depression, and the spike in oil prices could worsen. Stock markets are hitting new highs every day, which some believe is a bubble. However, the problem with bubbles is that they can go on longer than you think. Anomalies like the price of oil have occurred in the late 20th century, and the Phillips curve idea that low unemployment means higher inflation and high unemployment means lower inflation is nonsense. In the early 20th century, high unemployment, high inflation, and high interest rates led to stagnation, which lasted for most of the period from the creation of the Federal Reserve, Fed. The money supply has been decreasing for years, and the combination of lower money supply and lower velocity means the nominal GDP is ready to fall off a CL. Ben Baraky, a central banker studying the Great Depression, argued that the Fed could have more than doubled the money supply under the gold standard without breaking the law. He cited Ben Baraky's book as an example of how the Fed could have done this without breaking the law. The U.S. is currently in a disinflationary trend with the possibility of deflation and a severe recession. However, anomalies like the price of oil and the Phillips curve idea are not great time to dive into these trends. The author discusses the economic situation in the United States, focusing on the gold standard and its impact on the economy. He argues that the current money supply is not a better reflection of the economy than the gold standard, as it is shrinking and velocity is declining. The reasons for this are the same as during the Great Depression, such as banks not wanting to lend due to recession concerns, people not wanting to borrow due to bubbles or declining commercial real estate values, and people hoarding cash. The author also mentions a spike in oil prices, which could worsen the situation. They believe that the economy has been in a depression since the Great Depression, and people may not understand the definition of a recession. A recession is defined as 2 consecutive quarters of decline in GDP, while a depression is worse. The author believes that the U.S. will likely experience a severe recession, possibly already in one, and questions whether a banking panic will follow. The author also discusses the Russian way of war, which involves slow, methodical, and thorough defenses against the enemy. They argue that the financial sanctions have been a complete failure, and the situation is about to get worse. They also discuss the importance of understanding the Russian way of war and the potential consequences of financial sanctions on the economy. In conclusion, the author emphasizes the importance of understanding the Russian way of war and the potential consequences of financial sanctions on the economy. The text discusses the ongoing conflict between Russia and the United States, focusing on the future big brains of the elite group. The author argues that the sanctions are going to fail, and they will boomerang and hurt the United States more than they hurt Russia. However, the Russian economy is outperforming the U.S. economy, and the only economic problem Russia has is a labor shortage due to its hot economy. The author explains that the U.S. policy has been misguided, and the White House has been trying to make it worse by freezing Russian assets. The U.S. has already frozen reserves in Western banks, including U.S. Treasury securities, which Russia has strategically placed in gold. This has allowed the U.S. to seize these reserves, confiscate them, and use the money to rebuild. However, this approach has several problems, as Russia will take over the country at a rate they are going, leading to a default on U.S. Treasury securities. The author acknowledges that the rest of the world will look at countries with hundreds of billions of dollars or more in assets, such as Saudi Arabia, Taiwan, China, and South Korea, which have hundreds of billions or more in assets. The author suggests that the U.S. should not be able to rebuild the country due to the rapid pace of Russia's takeover, as there will be no change in Russia's behavior. The rise of the BRICS in the global financial system, including Brazil, Russia, India, China, South Africa, and Russia, has led to a significant increase in the value of the dollar. These countries are now working on their own currency, designed to recreate the British wood institutions. They have new development banks, such as the Shanghai Bank, which is a clone of the World Bank, and the Conditional Asset Reserve, which is a clone of the IMF swing lender for countries experiencing capital outflows. The Treasury and Fed have been meeting at different times to discuss the role of the dollar as a major global payment currency and ultimately as a reserve currency. Treasury official David Dollar, who was in charge of the dollar in terms of treasury layers, stated that the dollar has always been the global reserve currency. However, this overuse of sanctions can drive countries away from the dollar and undermine its role as a global payment currency. Russia is doing extremely well, and it is a key part of the BRICS. They are working together to create a new currency linked to gold, with its value determined by the weight of gold. This new currency will not be a strict gold standard, but will allow the dollar to do the dirty work in the gold market. The White House seems to be clueless about this, with Mike Johnson, the new Speaker of the House, appearing to be on board with the Russia confiscation. Some people may try to take Johnson aside and explain the situation. The U.S. is currently in a serious disinflationary mode, with the Red Sea and Canal closing, and oil from the Middle East and Europe flowing around Cape of Good Hope. This adds to transportation costs and puts upward pressure on oil prices. The U.S. is in a dangerously close to deflation, which creates difficulties for debtors and leads to defaults, which can lead to a recession and possibly a bank panic. The price of oil is going out due to geopolitical tensions, but transportation costs are going up, insurance costs are going up, and the Federal Reserve, Fed, will not cut interest rates. Wall Street has been wrong about the pivot for 2 years, and the Fed is expected to announce its decision in this meeting. The question now is what the U.S. will do about the dead U.S. servicemen and women, and whether it will involve an attack on Iran. This comes as the U.S. and Great Britain are in an escalatory dynamic with Iran, which has led to a crash in the housing market and Chinese real estate. China's recent bankruptcy has had a significant impact on the U.S. housing market, as Chinese people are unable to invest in Western stocks due to capital controls. While there are workarounds and money laundering, it is difficult for Chinese people to invest in anything except Chinese stocks and Chinese real estate. In conclusion, the U.S. and Great Britain are in an escalatory dynamic with Iran, and their diplomacy have not been effective in de-escalating the situation. The Chinese economy is facing significant challenges, with banks in distress due to lending money to properties that are going bankrupt. The Chinese stock market has been crashing, and wealth management products are failing as they are not bank deposits and are not guaranteed or protected. World trade is contracting, which rarely happens even in a recession. The U.S. is putting technological controls on Chinese exports, not allowing China to import high-tech semiconductor equipment or chips. Trump tariffs are still in place, and Chinese holdings of U.S. Treasury securities are declining. China's economy is mainly maintained through infrastructure spending, which is subsidized by the U.S. for train tickets. These projects create jobs but are mostly empty. The bullet train from Shanghai to Ning is an example of this, but it costs more than a train ticket. The infrastructure projects are not profitable, as they will never repay the debt and will never make money. The author suggests that China is in very bad shape, with growth slowing enormously. The statistics provided by the U.S. are likely overstated, but one can take mental adjustments to determine the value of these projects under general accounting principles. If a project is worth not being built, the accounts would say it was worth it. In conclusion, the Chinese economy is facing significant challenges due to the global dollar shortage, technological controls, and the need for infrastructure spending. The U.S. and China must address these issues to ensure the country's economic stability and avoid bankruptcy. China's slowdown in GDP and the global recession have led to a need for fiscal policy to prop up its headline GDP. The U.S. spends upwards of $1 trillion a year on deficit spending, which is not sustainable as it requires spending more than the GDP to maintain it. The debt-to-GDP ratio is getting worse, and the only way out is to either default or restructure. The U.S. has no reason to default or restructure because it prints money and borrows in dollars. Argentina needs to restructure their dollar-denominated debt, but the U.S.'s debt is dollar-denominated, so there is no reason to default or restructure. However, inflation may be the only way out on a long-term basis. China's invasion of Taiwan is not imminent due to the country's large and sophisticated semiconductor industry, particularly Taiwan Semiconductor Manufacturing Corporation, TSMC. The company makes the smallest and fastest chips using nanotechnology, which would not fall into the hands of China. If China invaded, either the U.S. or Taiwan would destroy all semiconductor manufacturing capability, leaving them in ruin. Taiwan Semiconductor knows this and is investing billions of dollars in building fabs, semiconductor fabrication plants in Arizona. They are already looking ahead to the day when Taiwan falls and want to get as much of their capacity out of Taiwan into the United States. While there are highly uncertain outcomes, there is a lot of hype at this point, and it is unlikely that China is ready to invade Taiwan in the short run. Thanks for watching our video. If you enjoyed it, don't forget to give it a thumbs up and subscribe to our channel for more content like this. Also, hit the notification bell so you never miss an update. Your support means the world to us. See you in the next video.